Hi guys, it's Sunday. It's the 11th of January. Tomorrow's the 12th and it's a big day. Normally I wouldn't do a video on a Sunday. But with tomorrow being such a big day because Basel III comes into full effect and it's going to change everything because the banks have to comply or get out. Have a look at this.
While the retail public was focused on the price charts, the real decision was made behind closed doors in Basel, Switzerland. The Bank for International Settlements, BIS, the central bank of central banks, has officially passed the final implementation phase of the Basel III endgame rules. This isn't a rumor. It is a regulatory mandate that goes into effect when markets open on Monday. They passed it quietly because they know it changes everything. This new rule forces banks to revalue how they hold gold and silver on their balance sheets. For decades, paper contracts were treated as good as gold. Starting Monday, that lie ends. To understand why this matters, you have to understand bank capital requirements. Before today, banks could hold unallocated gold and silver, paper promises, and count it as a safe asset. The new rule changes the net stable funding ratio, NSFR. It makes holding unallocated paper metal expensive and risky for the bank. It penalizes them for holding shorts. This forces banks to either buy physical metal to back their positions or exit the paper market entirely. They passed this rule to prevent another 2008 crisis, but in doing so, they have lit the fuse for a precious metals explosion. This rule is the death knell for the naked short selling that has suppressed silver for 40 years. JP Morgan and Citi can no longer hold billions in short positions without holding massive amounts of capital against them. It becomes too expensive to manipulate the price. The cost of carry has just skyrocketed. We are already seeing banks unwinding their short positions in the overnight markets to comply with the Monday deadline. This buying pressure is what will drive the price up, not speculation, but regulatory compliance. The most bullish part of this rule change is the reclassification of gold, and by proxy, silver, as a Tier 1 asset. Previously, gold was considered a risky asset like a stock. Now, it is considered risk-free capital, just like cash or treasuries. This incentivizes banks to buy physical metal to strengthen their balance sheets. They are moving from suppressing the price to hoarding the asset. When the banks switch from sellers to buyers, the price floor rises permanently. This explains the liquidity vacuum we saw last week. The banks withdrew their sell orders because they knew this rule was coming. They didn't want to be caught short when the new regulations kicked in. The market halted not because of a glitch, but because the market makers were stepping back to recalibrate their algorithms for the new Basel III reality. The game has changed from suppress the price to secure the asset. Industrial users like Tesla and Samsung are also aware of this rule change. They know that if banks stop selling paper silver, the price will rise to meet physical demand. This is why we are seeing panic buying in the industrial sector. They are trying to lock in supplies before the banking sector sucks up all the available physical inventory to meet their new capital requirements. It is a race between the factories and the banks, and there isn't enough silver for both. China has been compliant with these rules for months. The Shanghai Gold Exchange operates on a fully allocated physical basis. The West is just catching up. This rule change is effectively an admission that the Chinese model, physical, won over the Western model, paper. By passing this rule, Western regulators are aligning with the East. They are admitting that paper derivatives are dangerous and physical metal is the only true safety. Why should you care? Because this rule makes the banking system safer in the long run, but it makes the currency weaker. To buy the gold and silver they need, banks will have to sell dollars and treasuries. This puts downward pressure on the dollar. As gold and silver revalue higher to meet the new Tier 1 standards, the purchasing power of the fiat currency holding them up must fall. The revaluation of gold is the devaluation of the dollar. If you hold an unallocated silver account at a bank, this rule is a danger to you. The bank is incentivized to close your account or convert it to cash because holding your unallocated silver is now a liability for them. We expect to see banks sending letters to clients saying, "We are discontinuing our precious metals program. Here is a check." If you don't hold the physical metal, you're about to be cashed out at the worst possible time. You won't hear about NSFR or Basel III on the nightly news. It is too technical, too boring. But it is the plumbing of the financial system. The media will talk about market volatility, but they won't tell you the root cause. The root cause is a fundamental change in how banks are allowed to leverage paper assets. The era of infinite leverage ended last night. This is as significant as Nixon closing the gold window in 1971. In 1971, we moved away from metal. In 2026, with Basel III, we are moving back towards metal. It is a slow, bureaucratic return to a gold standard disguised as banking regulation. The central bankers know the debt is unsustainable. They are preparing the lifeboats, and the lifeboats are made of gold and silver. With the banks stepping back from manipulation due to these new costs, true price discovery can finally happen. We might see extreme volatility in the short term as the paper shorts cover, but the long-term trend is set. The price must rise to a level where physical supply meets physical demand without the interference of paper dilution. That price is significantly higher than $85. Because banks have to hold more capital, they will lend less money. This rule change will trigger a credit crunch in the general economy. It will be harder to get a mortgage or a business loan starting Monday. This deflationary pressure in the economy will be met with inflationary printing by the Fed, creating stagflation. In a stagflationary environment, silver is the best performing asset class. The smart move is to align yourself with the banks. If the banks are being forced to hold physical metal, you should hold physical metal. If the banks are exiting paper contracts, you should exit paper contracts. Do not bet against the new rules. The wind is blowing towards tangible assets. They passed it. The rules have changed. Monday morning marks the start of the Basel III era. The banks are scrambling to comply, the shorts are covering, and the physical market is tightening. This is not a conspiracy, it is a regulatory reset. The paper game is over. The physical game has begun. For years, the London Bullion Market Association, LBMA, operated with a loophole that allowed unallocated gold to be counted as a high-quality asset. This allowed banks to lease the same bar of gold multiple times, creating a paper pyramid scheme. Basel III closes this loophole. It demands that for an asset to be Tier 1, it must be allocated and physically present. This forces the LBMA clearing banks to scramble for physical inventory. The days of fractional reserve bullion banking are ending. When London demands physical delivery to meet these new ratios, the drain on global vaults will accelerate to a pace we have never seen. The entire $100 trillion derivatives market rests on the stability of the banking system's collateral. By forcing banks to hold better collateral, gold, silver, Basel III makes trading derivatives more expensive. We expect to see a massive deleveraging event. Hedge funds that use cheap leverage to short silver will be forced to close their positions because the banks will no longer lend to them at low rates. This short covering rally will be driven by the mechanics of the banking system, not just market sentiment. Sovereign wealth funds in the Middle East and Asia have been preparing for this rule change. They knew that once gold became a Tier 1 asset, its value would have to rise to support the global balance sheet. They have been front-running this regulation for 2 years. Now that the rule is live, we expect them to publicly announce new allocations to precious metals. When a fund with $1 trillion under management moves 1% into silver, the market explodes. While Basel III focuses on gold, silver benefits by association. Historically, silver and gold move together. As gold reclaims its status as the ultimate money for central banks, silver reclaims its status as the ultimate money for the people. The gold to silver ratio will contract as investors realize that silver is the undervalued sibling of the new Tier 1 asset. We are witnessing the stealth remonetization of the entire precious metals complex. Ironically, these rules were designed to make banks safer, but in the short term they make them more vulnerable. Many banks do not have enough physical metal to meet the requirements. To get it, they have to buy it on the open market, driving the price up against their own short positions. This creates a doom loop where complying with the law bankrupts the bank. The Fed will likely have to print money to help them buy the gold. This is inflationary. There's a conflict between Basel III, hard money, and CBDCs, digital money. While one arm of the global elite pushes for digital control, the banking regulators are pushing for physical collateral. This suggests a split in the establishment. The commercial banks want gold to survive. The central banks want CBDCs to control. In this war between factions, the individual investor can win by holding the asset that both sides need, physical metal. With the new rules come new audits. Regulators will be checking the vaults to ensure the metal is actually there. We suspect that many banks have been counting leased metal as their own. When the auditors arrive this quarter, the double counting fraud will be exposed. A bank that cannot prove it has the metal will be shut down or bailed out. The demand for audit-proof physical bars will skyrocket. We must remember the miners. This rule change incentivizes miners to sell their product directly to banks, bypassing the retail market. If JP Morgan needs 50 million ounces to meet Basel III requirements, they will buy it straight from the mine. This leaves zero supply for the Apple, Tesla, and the retail coin shop. The squeeze on the retail investor will get tighter as the banks hoard the supply for regulatory compliance. While the rule starts Monday, the full implementation is a process. Banks have been given a transition period, but the market is forward-looking. The market prices in the future reality today. The smart money is not waiting for the final deadline. They are positioning now. By the time the full impact is felt in 2026, the price of silver will already be in triple digits. They passed it. The era of paper manipulation is ending, not because the banks wanted it to, but because the regulators forced it to. Basel III is the catalyst that forces the system to be honest. Honest money means higher prices for gold and silver. The banks are buying, the nations are buying. The question is, are you? History rhymes. In 1933, they confiscated gold to revalue it. In 1971, they abandoned gold to print money. In 2026, with Basel III, they are remonetizing gold to save the system. Every time the rules change, there's a massive transfer of wealth. The people who held paper assets lost everything. The people who held physical metal preserved their purchasing power. This rule change is the signal that the cycle is turning again. The system is admitting that fiat currency has failed, and they are retreating to the safety of hard assets. Why now? Because inflation is sticky. The central banks know they cannot get inflation back to 2% without crashing the economy. So they are changing the definition of safe assets. By making gold and silver tier 1, they are creating a new anchor for the financial system that can withstand high inflation. They are preparing for a decade of high prices. If the banks are hedging against inflation with metal, you should be doing the exact same thing. For 40 years, U.S. Treasury bonds were the ultimate safe haven. Basel III challenges this. By elevating gold to the same status as bonds, the regulators are admitting that bonds, which lose value when rates rise, are no longer the only risk-free asset. This will cause a secular shift of capital out of the bond market and into the metals market. Trillions of dollars will rotate. Even a 1% shift from bonds to silver would double the price of silver overnight. You have heard about the global reset. This is it. It isn't a single event. It is a series of rule changes. Basel III is a key pillar of the reset. It reestablishes gold as the center of the financial solar system. This moves us away from a US-centric dollar system to a neutral asset-backed system. This levels the playing field for countries like China and Russia who hold massive metal reserves. The West is conceding economic ground to the East through regulation. The document is signed, the rule is active, the banks are moving. The window to front-run this regulatory shift is closing fast. Once the full weight of the banking sector enters the physical market, the retail investor will be priced out. Do not wait for the news to tell you what to do. The news is written by the people who want to buy your silver cheap. Look at the rules they passed. They passed them for a reason. Follow the money, not the rhetoric. Buy what the banks are buying, not what they are selling.
Noble Gold. Real assets, real value.